the quantum of shopping on the e-commerce platforms has multiplied multifold. So how are companies benefiting from this? Intrasoft Technologies is one such play, which caters to the US consumer, and they are, as I read in a report, in the first 100 Amazon marketplace sellers. What makes them so special? What makes the stock interesting? Let's find out more from the company's managing director, Arvind Karjaria. He joins us right now on the show. Mr. Karjaria, good having you. Thanks so much for joining in. Now, firstly, tell our viewers, what do you do as a company? Are you a marketplace, or are you a sourcer which sells things on marketplaces like Amazon? What's your business model?
Good morning, and thank you for having me. We run a website called 123stores.com, which essentially is then buying and sourcing all the products from the vendors on the left side, and then in a shop and shop format, in turn retails on across all the large marketplaces in the US. The belief here is, the ethos here is that the vendors themselves, the brand owners, do not have the digital expertise to manage the nuances of online selling. And since, like you yourself said, the quantum of online sales is increasing, by many folds, and it's showing even a higher trajectory year on year, the vendors would like to see their online sales go as well. So rather than do it yourself, which is very expensive and somewhat not within the realm, they choose to do business with us, which is called third-party vendors. We become their partners. We strategize their strategy with them for online sales, and work and use our technological expertise to make sure that their goods are being pushed more and more online. That's the overall business model.
And they stay exclusive to you, or do these vendors use other platforms as well to sell their products?
No, they are completely their product. We are one of the many vendors they could have. We are probably one of the many platforms they could sell. Even at this stage, just to give you a size of the market, no vendor really has more than, like 10 to 15% of their products being sold online. So 85% is still offline, traditional retail the distribution that they enter into. It is still relatively new for them. I know it's been around 10 years, but still only 15% of their entire sales accounts for online. I see that as a positive. It shows that the large size of our addressable market.
No, which I'm sure of, Mr. Karjaria, but I was just trying to get a sense of whether these vendors would want to increase their business meaningfully through you, or because they have a choice of going to almost anybody who might be following a model like you, that the loyalty factor doesn't quite stay. I don't know what your experience has been, if you can share that.
Yeah. You have to be efficient. Okay? So I've answered this question in a little roundabout fashion. If you're efficient, then the marketplaces confer a premier status on you, and they give you like a premium placement on the website. It's to do with the customer ratings that you have. It's to do with the pricing that you have. So the moment you have the premium placement, what happens is all the sales are channelized through you. And that in effect becomes a great motivation for an edge, a USP kind of sorts, for the vendors to do business with you. Because, traditionally, whoever is the number one seller, whoever is the number one rated seller on the marketplace walks away with almost 80 to 90% of the business. So in order to increase the business, you need to be efficient on the back end. And you get these ratings only because you're A, the cheapest, and B, you do the deliveries within the fastest amount of time and are never out of stock.
Okay, so you kind of differentiating yourself via technology. And I have two questions to this. One is actually from my analyst, Agam. He's wanting to know that if you differentiate yourself by technology, and if our understanding is correct, what are you doing to kind of safeguard that moat that you have around yourselves? Because you are in the first 100 Amazon marketplace sellers for a reason, and technology could be one factor driving that. How are you safeguarding that moat?
Yeah, we do believe that our edge is technology, and the way we safeguard is you're always on the edge. So you're always leading the pack rather than following somebody else. So a large portion of our team is technology. A large portion of our investments is into the technology phase. I'll just give you a quick example. Suppose a product gets lost, we would know within a matter of minutes that the product has gone off the radar. And then we would take a proactive step of calling the consumer and doing a damage control as soon as possible and to the largest extent possible. It's another matter that how you deal with them. But none of the vendors themselves or none of the 3Ps have like a 24/7 support or some technology that tells them that something is wrong on a real-time basis. So it's just a small example that I shared with you.
Okay. Now, being in this first 100 Amazon marketplace sellers is terrific. The question that I have is that in your quest for growth in numbers, which will either come via increasing products or increasing vendors or a combination of both, would that happen at the cost of, say, return ratios, of margins, of profitability?
Our model is quite, now emancipated. So all our funding actually comes through vendor credit. So we generate a lot of free cash flows. So the moment that happens, and we're not looking to raise more money or dilute capital, what that does is that we are not very margin focused then. So our focus is then moved on to an absolute EBITDA growth, which would then, enhance the ROE. So we have a double advantage of not really being able to reduce the margins. We can reduce the operating margin and yet increase the absolute EBITDA and the ROE.
Okay. So you're saying that your return ratios will not come off even if you follow this quest of trying to raise revenues via introducing more products or vendors or both?
Well, we are cognizant of the fact that we would like to remain profitable. We don't want to grow incessantly at the cost of profit. However, there may be times when the momentum is with us, or we've got some interesting products that we may need to come at a price that is not very profitable or as profitable as the other mature products. So we may enter into that. But overall, what I'm saying is that we expect to see increasing absolute EBITDA on a quarter-to-quarter basis.
Okay, so okay, let me first ask you, how do you think people are valuing companies such as yours? And the reason I ask this to you is when I looked at your shareholding some time back, if I'm not wrong, you've I think University of Notre Dame and Washington University have about 9% stake. I would presume this would have been done via preferential allotment or otherwise, and please correct me if I'm wrong here. But how are these investors who are large investors, US-based investors, valuing their investment into a company like yours?
So that would be a difficult question for me to answer on how they would evaluate us. We did pitch to them and they found it interesting, and then they took up the stake. That said, I think globally, what I understand is most of these investors, value it probably on a DCF model. And since we are generating free cash flows and expected to, continue to do that, I guess we would, be part of their overall DCF model.
Okay, yeah. No, the reason I was asking this, Mr. Karjaria, is that, and you are a company in the growth phase, because if I just look at your numbers, if I look at PE as an absolute measure, it's ridiculously expensive. But I'm guessing investors are probably not looking at a simple metric like a price to earning necessarily to value their investment in a company like yours.
I guess we'll have to ask the analysts that. I really can't comment on that.
Fair call. My last question to you is about, and you in part answered my previous question, which is the need for raising capital in order to expand business. I'm guessing you're not in a hurry to raise any capital, at least not for the foreseeable future.
No, like I've repeatedly mentioned, part of our model is to rely, we believe that our brand is strong enough to generate vendor credit, which in turn fuels the inventory that we need to keep in order to increase and boost sales. So it's a cycle. The better that we are, the more offtake we're able to give our vendors, the more business we give them, the longer we work with them, our credit worthiness goes up. The moment that goes up, we have access to, vendor credit, and that is what keeps our business going more and more. So I don't, in the interim or in the near future, we don't have any plans to dilute equity or raise capital. And we do have a certain amount of debt. We would continue to use that debt.
Okay, and you would grow at the rate, whatever, 25-30%, whatever the internal rate would be for the next few years, with margins staying at the current levels, or is there an internal target to even expand the EBITDA margins? I know you mentioned in one of your con call transcripts that you don't want to raise margins. You will grow despite margins being stagnant. But is there a plan to raise those margins as well over the course of the next 3-4 years from the current 1.5, 1.8%?
Like we both agree, the size of the market is large enough. So, within that, I think 25-30% is something that, we believe our systems are capable of regenerating themselves every year to look at that growth. Like with margins, I've already said, with this kind of a momentum in the play and with so many third parties, it's a very competitive business. So we will not be in a situation where we are margin focused and allow a lot of our competitors to get into this, what we believe is a phenomenal business, which will generate incomes for years to come. Okay. So we are cognizant of the fact that we are not going to lose money or have a cash burn. We are cognizant of the fact that we have a responsibility to ourselves to generate profits in our business. But, we don't see us increasing margins in the near future. Okay, what we do see is,
please carry on.
Please go ahead. No, so like I'm repeating myself, since we are not diluting equity, any absolute EBITDA would also generate a higher, kind of a net profit.
Okay, my last question to you is, internally, do you think there is a runway open for you to grow at 20-25% CAGR for, say, the next 5 years or longer?
Well, like I said, the market is certainly there. We are certainly focused on it. The team is ready. So, I'm not going to commit that we can do it, but the opportunity is certainly there, and we are very focused on making the most of the opportunity that we have.
Great. We wish you all the best for that. Thanks so much for taking the time out and being with us today, Mr. Karjaria. Have a great week ahead.